Most UK directors glaze over when we show them a balance sheet, but actually it's a really important tool, and there's two key lines on here that will show whether your business is healthy or in danger. Hi, I'm Mark from your finance team. Today I'm going to break down how to read a balance sheet without the jargon. So let's start from the beginning. A balance sheet would typically be presented to you as a company director at your year end after your accountants have done your year end. You can also potentially see a balance sheet on your accounting software as well. So if you're using Xero or QuickBooks, then all of these have a balance sheet function. But a word of warning with these balance sheets on Xero and QuickBooks: if your accounts are not up to date, if your bank reconciliation is not up to date, then the balance sheet will not be up to date as well. So just make sure that everything has been correctly accounted for before running your balance sheet on Xero or QuickBooks. So let's dive in. So what we can see here is a typical example of a company balance sheet in the UK. And this starts off with just a preamble, so company name, the company number, and the date at which the balance sheet applies. And remember, the balance sheet applies as at a point in time, okay? It's not the same as a profit and loss. A profit and loss will cover a period of time. And so if you're doing annual accounts, it will cover a 12-month window. Your balance sheet is purely a snapshot at a point in time. And in this case, it's shown as the 31st December 2024. So what's the first thing you'd expect to see on a balance sheet? The first thing you expect to see is your fixed assets. And what these are is things that your company owns. And these are generally the bigger items that a company owns. So you would expect to see things like plant, equipment, buildings, vehicles. So if you imagine anything that's sort of physical and big, it would show under fixed assets or tangible fixed assets. And the way that most balance sheets present this information, it shows the cost, so how much that asset cost the company, less depreciation. And what depreciation is, it's a recognition that over time, that cost of that asset will become less. So just through sort of obsolescence and wear and tear and things like that, the cost of that asset will decline over time. And that's what depreciation is aiming to do. It's basically saying, look, that asset has got an economic life. So if you're thinking about computing, for example, an asset there might have a 4-year life. And therefore, if it costs you £1,000, it would be depreciated at £250 a year over that 4-year period. And over 4 years, effectively, then it would just be written off in the books over that period of time. So that's what it means by depreciation. The other area we've got on here is intangible assets. So these are non-physical assets. So a good example of that is things like software licenses. So you don't actually buy anything physical when you get a license, but it does cost you money. And often those licenses will be for a period of longer than 1 year. And therefore what you're doing over the life of that license is effectively depreciating it, or the correct terminology is amortization. But really what you're doing is you are recognizing the cost of that license over the license term, and then effectively writing off that license over its license term. So if it's a 3-year license, you write it off over 3 years. And then those areas add up to become your total fixed assets. And each year, normally your accountant will check with you to make sure that those assets are, one, still in the business, so they haven't been written off or sold or anything like that, just check they're still there. And also they'll check with you to see what they call the carrying value of those assets are. So what's the true value of those assets, to determine whether they need to adjust the carrying value of those assets in the books for that particular year. So just make sure that your accountant is asking you each year to check your fixed asset register. Next area is current assets. So again, assets, so it's things that you own. So the first one we've got on here is stock. And this is stock which is effectively held in your business. So the business has purchased this stock, but it hasn't sold it at the year-end point. So in this case, at 31st December 2024, there's still £10,000 worth of stock left in the business. So the company's paid for it, but it hasn't used it yet. It's effectively, so it might be sat in a warehouse, it might be sat in a shop, but it's not been sold, and therefore it's what we call stock on hand. It's stock that is available to potentially resell at a later point. So again, that's an asset of the business. The business has paid for it, it owns it, it just hasn't used it yet or consumed it yet as part of its trade. So therefore it's held on the balance sheet as an asset. And the way this is accounted for, the stock is accounted for, is the cost of the stock, so what it cost you. So again, it's important. It's not what the resale value is, what it cost the business, or what we call realisable value. And what realisable value means is that if that stock has been damaged at all, say you paid £50 for a unit of stock, it then got knocked about in the warehouse and only worth £40 now, then the realisable value would be £40, not £50, because effectively it's been damaged. So it's the lower of the cost and realisable value is how that one is effectively priced. Next one here, trade debtors. Important one, this one. This is who owes you money at the year end. So in this scenario, £15,000 is owed to you from your customers or clients at the year end point. And it's important that you keep an eye on your debtors value, because this is potentially money that's owed to you, and you want to make sure that you're on top of this figure and making sure that people are paying you in a timely way. If people aren't paying you on time, that figure might start to creep up. And that's bad news for your business, because you should be trying to convert this figure into cash potentially as quickly as possible, because the longer it stays outstanding, people haven't paid you, then that's potentially got a negative impact on your cash flow. So that is trade debtors, and again you should be checking that as part of the year-end process to make sure that figure is correct, and that in this case £15,000 is genuinely owed to you. If anything is bad, so there's any bad debt in there, again talk to your accountant about that, because that may need to be adjusted for. What we don't want to be doing is carrying bad debt in your trade debtors, because that should be dealt with as well as part of your year end. Next one on the cash at hand and in bank, it's basically your bank balance at year end. In this case, there's £20,000 held in the bank at year end, so that's quite a sort of straightforward measure, quite a sort of pure measure. You can't really argue with that. That was your cash balance, and if you've got any petty cash in the business as well, that would also be included there. So it's normally the sum of all your bank accounts plus any petty cash balances would be your cash in bank figure, and then sum all of those three figures up, down, gives you your total current assets in the business. Next, so that's asset. Moving on to creditors. The creditors, again, it's sort of it's a term that's not often easily understood, but this is what you owe. This is what the company owes at year end. So your trade creditors are effectively your suppliers. So in this scenario, it's saying that £12,000 was owed to your suppliers at year end, and these are the things that are going to have to be paid over time. So as at the year end point, £12,000 was owed, and then assuming that you should be paying your suppliers on time, that £12,000 would effectively unwind over a period of time. But obviously, new supplier invoices we receive, so that's kind of a moving figure as supplier invoices are received and paid. But in this scenario, it's saying that £12,000 was owed to suppliers. And what we would be looking for, as a potential red flag, is if that trade creditor figure is increasing relative to the size of your business. It could be an indication that you're not paying suppliers on time, which has got implications, and is again a potential red flag. Why aren't suppliers being paid in time? Is it an indication of cash flow problems, or something else going on in the business? Again, it's quite a sort of key one that certainly we keep an eye on as accountants, and you should keep an eye on as well. Next one on there is corporation tax payable. So again, it's a creditor. It's money that the company owes, but is not potentially due yet. So with corporation tax, you get your year end. You then get 9 months, 9 months and 1 day to pay your corporation tax. So therefore, the money is owed, and therefore it's reflected on the balance sheet as an amount owed. But it's not doing anything wrong. It's not due yet, but it is effectively going to be owed at some point to the tax office, to HMRC. So that's why it goes onto your balance sheet as an amount that's owed. Other creditors and accruals. So if there are any expenses that perhaps you haven't been invoiced yet for, but you will receive or you expect to receive an invoice for, then these will be treated in accounts as an accrual. And again, this is a timing difference or timing adjustment that we put into the accounts to recognise that you are effectively going to be billed from a supplier. You've probably consumed the service, but you just haven't received the bill yet, and therefore it is allowable to put an accrual into your books. And then when the actual invoice turns up from the supplier, that accrual would effectively be removed and the invoice comes in. So again, it's an adjustment in the accounts to account for that timing difference in the accounts. And then all those things sum down to give you total current liabilities. So if you take your current assets less your current liabilities, in this case we've got a positive position of £23,000, and that's a sort of sign of a healthy business, because what it's saying is at the moment this business can cover its liabilities. It's got enough in its current assets to cover its liabilities. So again, it's a positive indicator. If that number was negative, then potentially you've got a problem there, because what that's saying is you haven't got enough enough assets to cover your short-term liabilities and short-term creditors, and that could represent a problem as well, and would potentially need to be looked at. Next figure on there, total current assets less current liabilities, is basically looking at all your assets, so total assets less your current liabilities. And again, this figure is positive here, which again is an indication of the company is healthy in this situation. We're then looking at longer term creditors. So these are money that is owed to people, in this case is a bank, so money that is owed to the bank, but it's not going to need to be paid back within the next year. Okay, so it's called creditors amounts due in 1 year, which is a long-winded title of saying, look, if I've got a bank loan, I'm not going to need to repay that bank loan for more than 1 year. So it is an amount that's owed, but it's not a short-term creditor. It's not something that's going to need to be paid off soon or immediately. So again, that is held on your balance sheet and carry forward as an amount that's potentially owed. And then you've got a net assets figure there. So if you add up all of your assets, all your creditors, take your creditors off your assets, then you've got again £33,000, which is a positive position to be in when you're looking at your balance sheet. Lastly on your balance sheet, and this area sort of causes a little bit of confusion sometimes. It's not, often people understand that, this is what I owe, this is what I owe, but the bottom of your balance sheet, the capital reserves element, is a little bit, can be a little bit confusing for people. So the first line you've got here is what we call called up share capital. So, when you set up your business, you would have had a number of shares, and those shares would have had a nominal value. And what this is capturing is the nominal value of the shares times by the number of shares in issue. And in this case, it's got £1,000, so that could be, doesn't actually tell you the composition of there, but it could be 1,000 £1 shares equals £1,000 worth of share capital. Equally, it could be 500 shares with a nominal value of £2. And that again gets carried on your balance sheet and gets carried forward effectively until the share capital is reduced. And often that number doesn't change unless you issue shares or buy back shares. That number doesn't often change in the company accounts. Next line on the accounts is your profit and loss account. Again, this is quite a key number. What the profit and loss account captures is the profit and loss in the prior year, but also retained profits from previous years to that as well. So if you're profitable every year, that profit and loss figure will continue to go up. However, if your profits start to dip, you will dip down, your retained profits will start to potentially fall. So again, this is a sort of key indicator. If you're comparing balance sheet from 1 year to the next year, that profit and loss figure will dictate whether the profits are accumulating in the business, are you getting better, or you might be losing money, and therefore those profits are starting to fall. So that's a really sort of important measure of how profitable the business is. And certainly credit reference agencies, when they're looking at balance sheet, that's one of the key variables they'll look at is your retained profits in the business, because it gives you an idea or gives a sense of financial health. If that figure is going down or becoming negative, then that implies you've got negative retained profits in the business. So that is again a red flag to your business. And then shareholders' funds is really the accumulation of the two of those. So it's basically adding the share capital to your profit and loss to give you total shareholders' funds in the business. And this sort of notion of balance sheet, basically what it's saying is that shareholders' funds at 33,000 has to equal the net assets in the business of £33,000. So those two amounts have to equal, and then just naturally will, as long as your balance sheet has been done correctly. So it's something to look at. If you're looking at a balance sheet, just make sure that it does agree, it should agree. So that's really a whistle-stop tour of a limited company balance sheet. If your company's bigger or more complicated, there probably will be more lines on that. But they are, what we've gone through today are the key lines and the key things to look for when you're reviewing your balance sheet in your business. So if you do need to, I'll just show you quickly, if you do want to have a look in Xero, for example, I'll just show you the sort of steps to running a balance sheet in Xero. So this is a demo company we've got set up in Xero. If you want to run your own balance sheet, you would go to accounting here, and then go down to the balance sheet here, and then it will run a balance sheet. There's not much on the, there's not much on here as an example really, but more just to give you sort of practical steps on how you would run a balance sheet in Xero. Select the date range you want. So if you want it to the end of last financial year, or you might want it today, select that, update, and then that will give you your balance sheet as it stands today in the business. But just a caveat, just sort of the health warning that I gave you earlier, the accuracy of your balance sheet in Xero or QuickBooks or any accounting software is only going to be accurate if all of your bookkeeping is up to date and it's all been done accurately. If it's not, there could be mispostings on here and you could be misinterpreting the figures on here. So check in with your accountant or bookkeeper. Just ask the question, is my balance sheet up to date? Can I look at this? And if the answer to that is yes, then obviously go ahead and look at that. But if it's not, make sure your accountant or bookkeeper have done the necessary to get your figures up to date before you run these reports. I hope you found that useful. If we can answer any questions or provide any help or advice on this, then please do get in touch. Thanks very much.